Well, as Tom just mentioned, the big retailer Myer had a horror week after announcing an ugly and unforeseen profit downgrade. And it could just be the start of a significant trend as Australian households lurch from spending to saving in the most dramatic swing across all developed economies since the GFC. And while it's taken the heat off interest rates for the time being, it's putting it back on retailers, a fact noted by Reserve Bank Governor Glenn Stevens on Friday in his biannual chat to the House of Representatives Standing Committee on Economics. Neil Woolrich reports.
Now, there's one little thing that everybody knows.
Back in the old days, saving money was child's play.
Money in the savings tree is safe.
And grows! And grows!
Over the years, though, Australia went from a nation of penny pinchers in the 50s and 60s to big spenders as credit surged from the 1990s. But now, in the wake of the global financial crisis, a new wave of austerity is emerging and the tight-fisted consumer is making a comeback.
Frankly, it's extraordinary. We are, for example, currently 4 times that of the US, despite the fact that they're in technical recession. We're much better than almost all the European countries. We're curiously a nation of good savers.
And that's a double-edged sword, as the Reserve Bank Governor acknowledged on Friday in front of the House of Representatives Economics Committee.
This is no doubt a difficult environment for retailers. From a macroeconomic point of view, perhaps on balance, it's not entirely unwelcome in the current circumstances.
In the 1980s, Australia's net saving rate was above 15%, but steadily fell until a decade ago, when households were on average spending more than they were earning. But since then, the saving rate has picked up, spiking dramatically during the global financial crisis.
I think a key factor has been that household wealth has been growing at a lesser pace. What we saw is that house prices rose very rapidly between 1997 and 2003. In fact, they rose much faster than income growth. And so a lot of the saving was being done for households by capital gains in the housing stock.
Look, if it's sustained, you would expect to see expenditure redirected towards investment and away from consumer discretionary spending. I don't think it's necessarily a positive or a negative. It's just more about who benefits more.
And the new conservatism among consumers, along with other threats like online shopping, means that some retailers have been doing it tough. The latest figures show retail spending grew just 0.2% in December and 2% for the year.
When we talk about the last 12 months, the first 6 months of the year was sensational. The second part of the year tended to drop down a little bit, but we finished up strongly at Christmas time.
Rod Smith says his boating accessories business has weathered the choppy seas better than most. In part, that's because his largely blue-collar clientele wasn't badly hurt by the GFC.
As Ratty said to Mole, there's nothing like messing about in boats, and we're in the boating business. I think that you find that people will spend if you've got product that they need, or you can help them determine that they need.
But still, his customers are always driving a hard bargain.
And nobody wants to pay retail price, and everybody asks, can you do better, or is that the best price you can do? And sometimes that's the hardest question to answer, but also can be the easiest, because if you're confident in your prices, you probably have set that price correctly in the first place, and the answer will be yes.
Retail analyst Andrew Inwood argues there's a two-speed labour market developing. He says while the headline unemployment figures look strong, there's a large number of white-collar workers who've had to take big pay cuts, and that's leading to softer spending overall.
If your jobs move from full-time to part-time, if your jobs move from full-time to contract, then your spending behaviour will necessarily change. You'll disappear from the unemployment figures, but you won't necessarily start to spend confidently because of what the economists call the permanent income hypothesis.
And that says if people worry about earning less in the future, they'll be less likely to spend. ICAP Australia's senior economist Adam Carr says while major department stores have suffered a downturn, many retailers are holding up much better than recent reports would suggest.
When you've got some retailers recording record profits, you've got the Australian Bureau of Statistics showing a clear pickup in consumer discretionary spending. So, look, I think that there are some misleading signals, and analysts are potentially confused by that, or maybe they're choosing to focus on that.
While it's impossible to say when consumption will pick up again, it's clear that higher than normal saving is making the Reserve Bank's job easier. The RBA is forecasting a big investment boom driven by the mining industry, so it needs to engineer a slowdown in the rest of the economy, especially consumer spending.
If consumption were to boom, at the same time as we try to expand the resources sector, upgrade urban infrastructure and increase our pace of housing construction to house a growing population, it will be harder to avoid the economy overheating.
I think the RBA want to hike rates. I think they acknowledge the need to do so, but they're seeing some confusing signals out of the CPI and some of the consumer spending data. What the savings rate allows them to do is sit back, or helps them to be able to sit back alongside a low CPI and assess what's going on.
I think the Reserve Bank is actually banking on the household saving ratio staying higher. They're talking a lot about households being more cautious in their behaviour, and it's that higher saving ratio that I think is a key thing that they're pointing to.
But that could all change and force the RBA to raise interest rates more aggressively if consumers once again raid their piggy banks and head out on a spending spree.